Meanwhile, I am delighted to introduce Joanne Kellerman here. Joanne has, since its inception at the beginning of last year, been a member of the Single Resolution Board, which is the EU's independent agency tasked to implement the Single Resolution Mechanism, which derives from the Banking Resolution Recovery Directive. And she will talk to us about this. Before this, Joanne is a lawyer. She has a Master in Law. She then joined the largest Netherlands legal firm and rose to become partner of the firm, and specializing on the financial side, was the firm's representative in London from 2001 to 2005, so also knows this country very well. And then went to work as General Counsel for the Netherlands Central Bank, and was then on the board of the Netherlands Central Bank, where we met each other in 2010 when I was leading the IMF's FSAP for the Netherlands. Yes, since then she moved on and it is now not only resolving Dutch banks, which were big, but also as a whole. I was just mentioning beforehand, when we came to do the FSAP, at that point, Netherlands and Britain had to spend the largest amount of money per capita on their banking systems of any European country. And I think, in fact, they were intertwined as well. I mean, the Netherlands had ING Bank and Fortis Bank and ABN AMRO, which of course was Royal Bank of Scotland here, which was the biggest bailout which the UK ever had. And part of this was due to problems in the resolution mechanism, which were found out there, that as banks came into difficulty, there were different legal deficiencies. And so the EU directive is really there to address these. And Joanne is there to make sure we don't have any of this again.
Absolutely. Thank you. Thank you, Charles. And yeah, it's interesting that you mention it, because that was actually for me the
sorry, can I just say, sorry,
trigger.
Sorry, final housekeeping thing. This the actual talk is open. Sorry, it's being recorded, and then questions and answers. We'll have question and answer sessions afterwards, and that will be Chatham House rules, which means that it's not attributed if you want to say something. So we hope fair, free, and frank discussion afterwards.
Yes.
You're okay?
Thank you. Yes. Yeah. And what I was saying is, you talked about the huge bailout of the Dutch financial sector. But there was also, of course, a big cross-border element in that. And I was personally involved in the demise of Fortis, where we had several weekends in Brussels with the authorities of the Netherlands, Belgium, France, etc. And that was actually for me an important, powerful motivation to move towards cross-border bank resolution, as I'm doing now. I'm a member of the board of the Single Resolution Board. I'm responsible for resolution planning and decisions, and I'll tell you a bit more about that soon. But today I'll illustrate an overview of the European regulatory framework for banks, speak about the SRB, about the Single Resolution Mechanism, and how they fit into the banking union. I'll talk about our resolution planning process, the various resolution tools, the objectives, the safeguards, and the goals we strive to achieve for the next year. And while doing so, I'll try to reason around one main question, and that is the question you see on the screen, whether financial stability and market discipline are conflicting, or whether they can be achieved equally and whether they can be aligned. So now, just quickly to the outline of today's talk. First, a bit about the crisis, because it's inevitable to look at the background for resolution. Then I'll go into the regulatory framework that came as an answer to the crisis, the measures taken globally and Europe-wide, the mission and distribution of tasks of the SRB and the Single Resolution Mechanism, the objectives of resolution and our role in that, what resolution really is, what are the resolution tools, a bit about the Single Resolution Fund, a bit about resolution planning, and a bit about what we will be doing next. And then I hope to be able to draw some conclusions. Well, the financial crisis. There's a lot to be said about that. A lot has been said, a lot has been written. But we're all very familiar with what happened, and I will not go into much detail here. But let me just briefly go back in time, lest we forget. Before the breakout of the financial crisis, the market for banks in Europe was originally based on a principle of minimum harmonization and mutual recognition of national banking licenses and supervision. And that goal did serve the opening of the national banking markets to cross-border competition in the last part of the 20th century. But that approach alone proved unfit when the financial crisis hit in 2008. First of all, it became apparent that the lack of common rules for European banks across the EU could have implications for the functioning of the internal market. And apart from resulting in regulatory arbitrage, the lack of common rules across the EU brought forward obstacles to cross-border business activities. National requirements were not geared towards the consolidated management of banks, and it emerged that fully harmonized rules were needed to address the drawbacks of national rules. Moreover, it was realized that the disruption of the critical functions of the banks could have massive consequences for stability, for market confidence, and in some places it did do significant damage to the real economy. And all this is not just on member state level, but at EU or Euro area level, one could say. And in fact, Europe lacked centralized decision making in the supervision side and in the resolution of cross-border banks. And as the crisis showed, that resulted in a vicious circle between member states' finances and their financial sector, as the member states had to massively intervene to the rescue of the banks through the ring fencing of bank assets and the provision of taxpayer-funded lifelines, the so-called bailouts. State aid to banks, a virtually non-existent case law in the EU before the crisis, amounted to nearly 400 cases between 2008 and 2012, and for an overall aid amount of 5,000 billion euros authorized by the Commission under various forms, in the forms of guarantees, asset relief, capital injections, etc., out of which 2,000 billion were effectively drawn, so actually paid out. And following that pattern, the banking crisis turned into a sovereign debt crisis, with huge consequences on the economy of member states and huge contagion spreading throughout the euro area. So the reaction at the EU level was twofold. First, a set of emergency remedies to put out the fire, to avoid the worst case scenario of uncontrolled contagion. And that is the case for the communications by the European Commission on state aid and for the interventions on member states through programs. And secondly, there was a legislative overhaul because clearly we needed European rules, and policymakers got to work to address the lessons learned from the crisis. And if we now concentrate on the latter, on the lessons learned, the Commission endorsed first the La Rosière report, which stated that inter alia, a single financial market in the EU, could not properly function if the rules were significantly different from one member state to another. And that resulted in the creation of the European System of Financial Supervision. And just to refresh in your mind, that resulted in the creation of a system of micro and macroprudential supervision consisting of European and national supervisors. The macroprudential pillar was formed by the European Banking Authority, EBA, the European Securities and Markets Authority, ESMA, and the European Insurance and Occupational Pensions Authority, EIOPA, which work together. And then there is macroprudential monitoring by the European Systemic Risk Board, the ESRB. However, the global and the European push for the creation of new legislation to avoid, manage and resolve banking crisis was to give further tangible results. And that we'll see on the next slide. In fact, it was quite difficult to end the so-called too big to fail problem and to end the undesired link between banks and public finances. But it did go to the top of the political agenda at global level as well, in the G20. And in November 2011, the G20 endorsed the key attributes. The key attributes for effective resolution regimes of the Financial Stability Board. And that became a new international standard for resolution regimes. And in parallel to that, in 2011, the European Commission brought forward proposals to strengthen the European banking sector. And the legislative package of the European Commission consisted of the Capital Requirements Directive governing the access to deposit-taking activities and providing principles for prudential supervision, and the Capital Requirements Regulation, the CRR, setting out detailed prudential requirements for banks and investment firms. And the proposals for the CRD4 and the CRR were still making their way through the legislative channels when, in 2012, the European Commission published two further legislative proposals. The first is aimed at establishing European rules for bank recovery and resolution, the Bank Recovery and Resolution Directive, the BRRD, and that establishes common rules and tools, including the bail-in tool, and provides for the establishment of national resolution authorities and for national resolution funds. Moreover, the BRRD requires resolution colleges to be established as platforms for coordination and cooperation with respect to banks with cross-border activities. And the BRRD applies at EU level for all 28 member states. And then there was the second legislative proposal revisiting the existing rules for deposit guarantee schemes and improve those rules for a revised Deposit Guarantee Schemes Directive, the DGSD. And that was all in the context of creating the single rule book. However, the financial crisis kept evolving, and the subsequent Eurozone debt crisis put the spotlight on the interdependencies between banks and national governments, as I indicated previously, this loop of doom. And it became clear that the single currency could be threatened by differing national responses, leading to fragmentation in the European financial sector. And so they felt a deeper, more institutional integration of the banking system was necessary in order to cut the link between bank crises and debt crisis, and to address the moral hazard deriving from the too big to fail perception. And therefore, building on the other legislative proposals of the DGSD and the BRRD in 2012, the Euro area institutions agreed on the unification of European supervisory and resolution systems by establishing a banking union. And the banking union consists of three pillars. First, the single supervisory mechanism, or the SSM, and as of November 2014, the SSM is the new system of banking supervision in the banking union, comprising the ECB and the national supervisory authorities of the participating member states. Within that new approach, it was acknowledged that a network of national resolution authorities and resolution funds would be inadequate for member states to share a common currency and whose banks are supervised by a single supervisory system. So as a consequence, in July 2014, together with finally adopting the BRRD, the EU adopted the Single Resolution Mechanism regulation, establishing the second pillar of the banking union. And the SRM regulation builds on the BRRD by enabling more effective cross-border resolution and by centralizing resolution decision-making with us, the SRB, in coordination with the national resolution authorities. And what is more, the SRM regulation created the Single Resolution Fund that replaces and comprises the national resolution funds for the Eurozone. And then there is the third pillar of the banking union, the proposed European Deposit Insurance Scheme, and that pillar isn't existing yet. It isn't there yet. It has not yet been established. The DGSD was adopted in 2014, and it has further harmonized the rules for deposit protection across the EU member states, but the European Commission has only published a proposal for deposit insurance on a Euro-wide scale, according to which the SRB would be the authority for a centralized deposit insurance fund, and it's highly uncertain at this point whether that will ever be turned into legislation. But if it were to become legislation, that would make the Single Resolution Board very similar to the FDIC, the Federal Deposit Insurance Corporation in the United States. Now, again, the BRRD, the DGSD, they're all Europe-wide. Banking Union, Single Resolution Mechanism, Single Resolution Regulation is only at the Eurozone level, so 19 member states. However, all the other EU member states are free to join the Banking Union if they want. So even the UK, still very welcome. So we've built this new framework, and now, of course, what is the underlying thought, and does it really work that way, is what you will ask. So let's pause for a minute so as to ponder briefly on my main question, the question I started off with, being, is there a trade-off between financial stability and market discipline? Should we give up one in order to secure the other, or can they be aligned, or can they exist next to each other? Well, before and during the crisis, authorities and states were faced with a dilemma, at least in certain jurisdictions, and in worst-case scenarios, either to let a bank fail and bear the consequences, or to use public money to save it. So, choice number one, if you emphasize market discipline, competitiveness, then, of course, you apply market discipline. The bank can't stay on the market out of its own force. It must therefore exit the market, whatever the cost. And that option is easier if the banks are not that big, if they're small, and if the adverse effects on stability can be contained. But if banks are big, however, the single failure of an institution without any safety net to manage the consequences is undesirable and, to say the least, risky. If you put the emphasis on stability, choice number two, that often was the choice of choice. Taxpayers' money was used to prevent the worst from happening, and that option is quite clearly spurring moral hazard and makes market discipline void. Moreover, as I've already highlighted, it can trigger such a depletion in public finances that the banking crisis may turn into a sovereign debt crisis. And that is precisely what we've seen happen, for instance, in Ireland, or also in other countries. So how can you bring down moral hazard and eliminate too big to fail, protect taxpayers' money, but at the same time make sure that banks can fail without hampering financial stability? In other words, how can we achieve stability without giving up on market discipline? And the answer to that is a credible resolution framework, at least for systemic institutions. A framework that is respectful of state aid rules, paired with a well-functioning distribution of tasks between the resolution authorities, the deposit guarantee funds, and the private safety nets. And surely that is one good answer to give. We feel that that framework has now been established in the banking union, and that is a big step forward in crisis management for the Eurozone. Prudential regulation and supervision, in fact, cater for the need to minimize the probability of default of banks. However, with the advent of the BRRD and the SRMR, also the idea to try and minimize the cost of failure, or the loss given default, if you like, when they happen, has come into full play. And this is how we can now rely on a set of provisions at the EU level which try and overcome the painful choice between financial stability and market discipline. And therefore, a bank should fail if it can't stay on the market, but the BRRD and the SRMR provide rules and tools to try and restructure the ailing bank so that stability is preserved throughout the process. However, there are a few caveats. And one central point to stress is that a resolution framework would be ill-fated if it wasn't founded on strong market discipline safeguards. And that is why the whole resolution architecture must rely on two specific principles or two sets of rules. On the one hand, full compliance with the state aid regulation. And secondly, a preference for private sector solutions so long as they can secure the goals of resolution. Now, with reference to state aid, it must be borne in mind that by explicit provisions, both the BRRD and of both the BRRD and the SRMR, any resolution action must be compliant with state aid rules. And in such view, the Commission scrutinizes any such action, especially with reference to the use of the Single Resolution Fund. And that is a key element to safeguard market discipline all through any crisis prevention and crisis management process. On top of that, the whole legislative approach of the second pillar of the banking union is crafted so as to favor, in any materially feasible fashion, the recourse to private sector measures in order to prevent and measure a situation of crisis. In order to prevent and manage a situation of crisis. Legislation is very explicit on such overarching principle. Just for instance, by explicit provision of the BRRD and the SRMR, it is one of three specific conditions for resolution that no other private sector measures can be timely and effectively used to bring the bank to safe shores. Should any such measure be available, no resolution action can take place. Now, let's now take a closer look at the Single Resolution Board's mission and its tasks, and let me tell you a little bit about what we do. We are an independent agency. We're a centralized resolution authority for Eurozone banks. You see here my fellow board members. We've done a very simplistic distribution of tasks within the board. We have a chair, we have a vice chair who is also responsible for the fund. We have a director of policy, that is Mauro Grande, and then Antonio Cascosa and Dominique Laboureix and myself. We are all three directors of resolution planning and decisions, and each of us has 6 countries. And of course one has 7 because we have 19 in total, and we all have a mix, some small, some big, some northern, some southern, etc. And that works very well. Our activities, as I said, are governed by the SRM regulation under which the SRB was set up. We are located in Brussels. We have a very specific structure. We officially opened our doors on the 1st of January 2015, but we only became fully operational and became authorized to use our powers on the 1st of January this year. By now we have recruited some 170 staff from all over the European Union. Different professional experiences coming both from the public sector and from the private sector. And by early 2017 we expect to have some 300 staff members. And our mission is to ensure an orderly resolution of failing banks with minimum impact on the real economy and on the public finances of the participating member states of the banking union. Our key responsibilities are to establish uniform rules and procedures for bank resolution, to establish a unified, credible and feasible resolution regime, and to remove obstacles to resolution, to ensure that all banks are capable of being resolved without recourse to public funds. And the SRB, together with the national resolution authorities for the Eurozone countries, comprised the single resolution mechanism, the second pillar, as I said, of the banking union. And we work in very close cooperation with the national resolution authorities of the member states that are part of the banking union. And as a matter of fact, we are the central body of a kind of hub and spoke system in which these national resolution authorities have a key role, both in resolution planning and in execution of resolution actions, as I will explain later. So we're built on a combination of local in-depth knowledge and centralized decision-making, in line with the motto of the EU, united in diversity. So how do we perform our tasks? The SRM contemplates a division of tasks between the SRB and the national authorities. The allocation of responsibilities is similar to the division of tasks within the SSM, that's headed by the ECB. The SRB and the ECB are both directly responsible for the significant banks established in the banking union, and the national supervisors and the national resolution authorities are primarily in charge of the smaller banks. And we thereby ensure consistency within the banking union. But our direct remit is not, however, exactly the same as that of the ECB. Unlike the ECB, we are not only directly responsible for significant banks, but also for other cross-border groups, meaning banking groups that have group entities in at least 2 member states participating in the banking union. So at present, our direct responsibility covers a total of 141 banks, including 128 banking groups, 113 significant groups, among which all the 8 global systemically important banks, or GSIBs, the big ones, established in the banking union, and 15 other cross-border groups. And the number of banks under the SRB's direct responsibility is continuously subject to change, since new banks can be established and existing banks can cease to exist or may be classified differently. Where we are directly responsible for the large banks and the other cross-border groups, the national resolution authorities are responsible for the smaller banks in the banking union. And they're also fully responsible for the resolution tasks relating to entities outside of the scope of the SRM, so standalone investment firms, branches of banks outside of the EU. And we, the SRB, have ultimate responsibility for the proper functioning of the SRM as a whole, similar to the ECB's ultimate responsibility for the proper functioning of the SSM. And to achieve that, we can take over the responsibility for a specific bank to ensure that there is a consistent application of the principles. We work closely together with the national authorities, and we've made so-called internal resolution teams, IRTs, composed of a mix of staff from them and from us. And in those teams we work closely together for resolution planning of banks. The NRAs, the National Resolution Authorities, are also represented in the decision-making within the SRM, because we have a special governance structure where the decision-making process differentiates between the type of decision that we take. It's different also from in the SSM. We have 2 different compositions, an executive session and a plenary session. The plenary session, in which all the national authorities are represented, can take general decisions that are not related to a specific bank, but the executive session takes all other decisions, including the decisions on resolution actions. So if we need to be quick, it's just the 5 of us, excluding the vice chair who has no voting power, who can take decisions. There's others at the table. The national resolution authorities of the countries where the bank is located are at the table, but ultimately they cannot take a decision unless we all reach a consensus. So if need be, we can be very quick and a very centralized decision-making body. And that's of course also necessary when you do crisis management. Now we work also very closely with the ECB, and with the national supervisory authorities, but also with the European Commission. The ECB clearly is a vital source of information about the banks under our purview, and moreover, cooperation is crucial for us, since the ECB is also competent to determine that the bank is likely to fail, or failing or likely to fail, and may need to be resolved. So we have a memorandum of understanding with the ECB, and we talk to them all the time, basically. The European Commission also has a role in our decision-making process. It may object to a resolution scheme proposed by the SRB, and as I highlighted, the Commission also checks draft resolution decisions on the compatibility with state aid decisions, watching over respecting this fundamental market discipline pillar. And because of their important role within our processes, the ECB and the Commission are permanent observers within both our executive and in our plenary sessions. Now, this framework, this architecture of structures and powers is addressed at securing very clear goals. And let's have a look at the goals for resolution. Because the legislation is not only there to focus on the crisis phase, but it is also and largely there to prevent and prepare both banks and authorities, and hence the relevant provisions on recovery and resolution plans. So in fact, prevention and preparation are two very hard drivers of this whole legislation. So consequently, our role is not just crisis management, but it's also forward-looking, because we are tasked with drawing up resolution plans and ensuring that each and every bank is resolvable, meaning that we can liquidate those banks and that they can be placed under resolution when that meets our objectives. So our main tasks, illustrated on the right-hand side of the slide, to draw up and adopt resolution plans for the banks under our direct responsibility. And in resolution planning, we have to make ex-ante important choices, because the resolution plan will indicate whether it would be expected that the bank would be wound up under normal insolvency proceedings or instead be placed under resolution. And in the latter case, it includes the preferred resolution strategy and the options for the resolution tools. We need to assess the resolvability of banks in order to assess whether it's feasible and credible to wind it back up again under normal insolvency proceedings, or to resolve it without causing any significant adverse consequences for the financial system. And if necessary, we need to address impediments to resolvability by means of a specific procedure in which the bank itself is involved. For example, we may require an entity to make changes to its legal or operational structures in order to ensure that critical functions may be legally or operationally separated from other functions when applying resolution tools. Another important task is that we set the minimum requirements for own funds and eligible liabilities. MREL, I'm sorry for all the acronyms, but that's a bit inevitable. And that is to ensure that there is sufficient loss-absorbing capacity in the case of a resolution. Another task is to start preparing for resolution, in particular when the situation of a bank is deteriorating significantly in the early intervention phase, and to adopt resolution schemes by placing an entity under resolution. And finally, we manage the single resolution fund and we decide on its use. Now, I will come back on most of these points a bit later, but let me stress again that our tasks are always aimed at making banks resolvable, ensuring that all banks are resolvable in the sense that they can either be liquidated or placed under resolution while meeting the resolution objectives. And so, on the left-hand side, you see the resolution objectives. One of the main objectives is to ensure the continuity of critical functions of the institution under resolution. Critical functions are those functions provided by a bank to third parties which, if they were to be suddenly disrupted, would likely have a material negative impact on such third parties and give rise to contagion or to undermine the general market confidence. Could be anything, could be deposit taking, lending, loan services, payment, clearing, custody, services like that. And that objective is closely linked with the other key resolution objective, which is to safeguard financial stability, obviously, by preventing contagion, but through application of market discipline. We take that objective into account throughout all the phases. And another objective clearly is to protect depositors and to allow them to have access to their deposits after the resolution has been done. And of course, the level of protection to the different classes of deposit holders varies. For example, the classic covered deposits up to 100,000 euros are automatically excluded from bail-in. Other kinds of deposits, such as deposits of natural persons and SMEs above the coverage level, can be excluded from bail-in, but only if that is justified by financial stability reasons and under certain conditions. The BRRD introduced a priority ranking of covered deposits and other deposits, which member states have to ensure in their national insolvency law. The fourth resolution objective, to protect taxpayers' money by preventing future bailouts, and it is in fact one of the resolution objectives to minimize the use of public funds. And in that regard, the SRM regulation provides that if extraordinary public financial support to a specific institution is required, the latter will generally be considered to be failing or likely to fail unless there are specific exemptions. Now, the SRM regulation also has specific circumstances and conditions under which the single resolution fund can be used. In fact, in order to fully comply with the overarching principle of market discipline, although the SRF is privately funded by the banking sector, it is considered to be extraordinary public financial support, and it is therefore subject to state aid rules. And therefore the Commission is mandated to scrutinize every proposal of use of the SRF possibly made by the SRB within a resolution scheme. Now, what is a resolution and what are the resolution tools? You'll see that on the next slide. Through resolution we face a new scenario. Those banks that can stay on the market will stay, and those that can't will exit the market, or at least their business will be restructured, and there will be no public aid. However, such exit from the market will be assessed under all viewpoints with reference to the possible detrimental consequences for stability, and action will be ready to be taken. So, if not normal insolvency procedures cannot ensure stability, resolution will. So, how would you define resolution? We usually say that it means the restructuring of a bank by a resolution authority through the use of resolution tools to ensure, inter alia, the continuity of its critical functions and the preservation of financial stability. And when does a resolution take place? Well, there are three triggers, or three conditions that must be met. In the first place, a bank must be assessed to be failing or likely to fail. Secondly, and here it comes again, it must be established that there is no other private sector intervention or supervisory action that can restore the bank back to viability within a reasonable time frame. So there must not be a private solution. And three, resolution must be in the public interest. And it's important to note in that context that not all banks will be placed under resolution if they are failing or likely to fail, because it follows from the legal framework that the failing bank should in principle just be wound down under normal insolvency proceedings. But if that cannot meet the resolution objectives I illustrated in the previous slide, to the same extent as resolution would, then only resolution will be deemed in the public interest. So there must always be a public interest, and often that will be financial stability, in order for resolution action to occur. And in order to make clear that distinction already in the resolution planning phase, we assess whether insolvency can be applied for a bank or not. Now, under the BRRD, there are 4 resolution tools. You see them here in the slide. Sale of business, bridge bank, asset separation, and the famous bail-in tool. Sale of business and bridge bank both entail a full or partial transfer of the shares or the assets and liabilities of an entity. The main difference is that with a bridge bank, the assets end up under the ownership of a public entity, and in the sale of a business, usually part of the business is transferred to a private entity. The bail-in tool is actually the most famous and probably the most complicated tool that we have. It can be used to write down and convert liabilities under 2 scenarios. The first is to recapitalize a bank with a view to enabling it to continue operating as a going concern, or to convert to equity or reduce the amount of claims or debt instruments that are transferred when the sale of business tool or the bridge bank tool or the asset separation tool are used. So we need, in order to harbor essential functions by capitalizing another institution. And in order to effectively make use of the bail-in tool, banks must be at all times meeting a minimum requirement for own funds and eligible liabilities. Here it comes again, the famous MREL acronym, which is determined for each entity during the resolution planning process. MREL is key to tackling the moral hazard and to strengthen market discipline ex ante and to break that vicious circle between sovereigns and banks. It is the European version of what the Americans call TLAC, total loss absorbing capacity, and it's different, but it's very similar. But the main thing to remember from this rather complicated concept is that it is there to make sure that banks can absorb losses. Losses are first to be absorbed by shareholders, either through the cancellation or the transfer of shares or through dilution. And where diluting shareholders is not sufficient, subordinated debt is converted or written down. And if that is not sufficient, senior liabilities can be converted or written down if the subordinated debt has been written down completely. There are certain liabilities that are excluded from bail-in, as I said, covered deposits, for instance. But in theory, all liabilities of a bank, other than that, can be written down in the context of the bail-in tool. And so it is a very powerful and a very intrusive tool to use. That is also the reason why there are several principles and safeguards in place for using those tools. They are very powerful tools, they have a serious impact, and the legal safeguards have therefore been carefully crafted. One of the most important principles to take into account in that context is the no creditor worse off principle. That is to say, no creditor may incur greater losses than it would have incurred if the entity had been wound up under normal insolvency proceedings. So there's always this sort of what-if scenario we need to play in order for us to make sure that creditors are not worse off. And to do so, in order to come up with a counterfactual, we have to do an ex post valuation of the estate of the resolved bank in order to check this. On to the next topic, because the SRMR has also put in place financing arrangements to fund resolution. And just to show you the Single Resolution Fund. The BRRD requires countries to have national financing arrangements for resolution to be pre-funded by the banks for use in future crises. But the Single Resolution Mechanism goes a step further by establishing a mutualized and a cross-border financing arrangement for bank funding. The Single Resolution Fund replaces national funds established under the BRRD, and over the course of 8 years, national contributions will merge to form a single, fully mutualized fund. It's an essential element without which the SRM could not function. Again, if resolution funding would have remained at the national level, the link between sovereigns and banks would not have been broken in the same way. So for us, it's very important. We administer this fund and we collect the contributions at the national level from the banks, and then they are transferred to the fund. We calculate those contributions and they are based on which banks are the riskiest. The riskiest banks contribute the most to the fund. The fund may only be used for specific purposes, and those purposes include making loans to a bank under resolution, capitalizing a bridge bank, or compensating creditors whose loss is greater than if the bank was liquidated. The fund cannot be used to absorb losses or to recapitalize a bank per se. If the fund use would indirectly lead to loss absorption or to recapitalization, that may only occur once shareholders or creditors have contributed. So, if we use the fund, there is a condition attached, and that means that losses up to at least 8% of the bank's total liabilities must first be borne by its shareholders and its creditors. Now, as I've said, we collect ex-ante contributions from the banks, but if those contributions are not enough, if we have a big case, we can also go back to the banks for ex-post contributions. And we can also raise alternative funding by borrowing from financial institutions or from countries or from third parties. But the important thing to remember from the Single Resolution Fund is that if we use it at all times, it must comply with state aid rules, and it is up to the European Commission to ratify or block the proposed use of the fund in a resolution. Now, as we've seen, the BRRD and the SRMR require both the banks but also the authorities to be prepared in advance. And the question is, of course, what does that mean for us as an authority? How do we put in place all these principles? How do we go about resolution planning? A resolution plan prepared by the Single Resolution Board sets out how a bank would be resolved should it be failing or likely to fail, and should the other conditions for resolution be met. Now, resolution plans should not be confused with recovery plans. Recovery plans are also drafted, but they are drafted by the banks themselves, and they serve as important input for our resolution planning. But the first step, as I've said, is to determine, can we apply normal insolvency proceedings to this bank, or do we need to apply resolution? And then we assess if the bank goes into insolvency, does that achieve the resolution objectives? Is it feasible? Is it credible? Will it involve financial stability or not? If the answer is yes, then it's normal insolvency and our job is very easy. The resolution plan will specify normal insolvency proceedings as the preferred resolution strategy. However, when a bank's insolvency does not achieve the resolution objectives, we need to adopt a resolution strategy that does meet those objectives. And in determining that strategy, we consider whether to adopt a single point of entry approach or a multiple point of entry approach. Single point of entry usually for groups with a concentration of assets and liabilities in one country, multiple point of entry with groups that are very decentralized over a multitude of countries. And then once we have the strategy, we look whether the bank is resolvable. And if we see obstacles, we seek to remove them and to overcome them. This could be a simple adjustment to the bank's operations, but it could also mean a significant reorganization of the banks carried out over a number of years. Resolution planning is an ongoing process. As you see, it's a circle, it's circular, it's not static, and it's a living document that we will adjust as the cycle goes on and over time. And at the Single Resolution Board, we committed to drafting plans that are practical, that can be implemented in practice and at any time. And also, of course, we try to harmonize those plans across the banking union, which is one of our key objectives. And to that end, we've developed, together with the national resolution authorities, a planning manual that we all use to ensure consistency. Now, finally, our key focus and the tasks ahead. What we've been doing this year is developing resolution plans for quite a number of banks. We are currently covering 90% of banks with resolution plans in various stages of advancement. That was an ambitious goal, and it required significant commitment and resources from all the entities, but also from the national authorities. We've prepared crisis management manuals, we have the resolution planning manual, we've published a booklet called Introduction to Resolution Planning that you can find on our website. And as I've said, key to our work is the fact that banks must have this minimum requirement for own funds and eligible liabilities. So we've started to interact with banks to talk about this MREL target, to start doing calculations, to have workshops with banks in order to align as much as possible our first thoughts about this with those of the banks. Secondly, we've established structures in order to prepare for resolution. As I mentioned, internal resolution teams, resolution colleges in which we discuss cross-border with our colleagues from abroad, within the EU, but also outside the EU, such as with the US. And we represent the banking union in those colleges and speak with one voice on behalf of the banking union. As I discussed before, we've set up the Single Resolution Fund. We calculated the first round of contributions, and we're currently setting our investment strategy to invest in highly liquid assets of high credit worthiness, actually in a low or negative interest rate environment. That will mean that we are not expecting a high return on our investment. On the contrary, that may well be a negative return for the time being, but there you go, not much to be done about that. Now, to wrap up, let me draw a couple of conclusions from all this. First of all, financial stability and market discipline are not conflicting principles, especially if the appropriate tools, such as a resolution framework, which is state aid compliant and paired with feasible private measures, are in place to achieve the first while applying the latter. We strive to achieve this at Eurozone level. The SRB's mission is to plan for the orderly resolution of failing banks in order to minimize adverse impacts on the real economy and on European public finances. Resolution, however, is the final option for a failing bank. A private solution is always preferred and should be pursued first, notwithstanding the use of normal insolvency proceedings. Only when the former have been exhausted may a bank enter resolution, and we've recently seen already how the presence of our new resolution regime has given incentives to shareholders and creditors to find private solutions in order to avoid resolution. The SRB will resolve banks whose failure is likely to have adverse systemic impacts, and to do this effectively we need to make banks more resolvable. And therefore we focus on resolution planning and on removing obstacles to resolution, because that should also make banks more robust, more resilient, and will improve financial stability and growth in the EU. And in achieving that outcome, the SRB will also help to avoid future bank bailouts. placing the burden of bank failure firmly onto banks' owners and onto creditors, and not onto the taxpayer. So thank you for your attention.